Is Drew and John Creekmer here with Creekmer Wealth Advisors, and we hope you guys are doing well since the last time that we chatted. In today's deep dive, we're going to talk about a topic that I think has been coming up a lot in both the news and in our meetings with clients, and that's what we're going to loosely call the impending tax storm. If you've been working with us for a couple of years now, you've definitely heard us talk about taxes and tax planning and how important it is. And we really wanted to devote some time here to kind of dive deeper into the current tax situation and where we're at in our country and some of the things that are impending from a policy standpoint. But before we do that, John, how you doing today?
I'm doing good. And last couple of days this week, I've just kind of been rocked a little bit with some things that have been put out by administration as far as in taxes. And, I'm not given to much hyperbole and big words, but I can just say in my 30 years of working in taxation and financial planning and money management, this is setting up for one of the biggest tax grabs or tax increases our country has seen, definitely in my career and in a long time. We're going to cover those things. And there's sometimes I hear people talking and they say, man, I hate paying my taxes, but what can I do? There's nothing I can do about it. I can't control Congress or the president or whatever they're doing. I just hate it. Well, don't put your head in the sand. It's all about strategic planning and doing what you can do to decrease your tax payments every year, but doing it legally. And the Internal Revenue Code is written in such a way where we can make some choices, some decisions, and all about decreasing your taxes, keeping more of your hard-earned money in your pocket instead of giving it away. So, I think things are setting up, man, just to be kind of potentially a staggering thing for a lot of people, and staggering not in a good way, but in a bad way, losing a whole bunch of their money.
Yeah, it definitely is, and it's something where being informed is really the best weapon that you can have available to you. And so let's kind of get informed about it. Let's talk about our first question here: is where are we at right now, and how did we get here? And there's been some stuff that's happened over the last year. But if we go back to 2016, that's when we had a tax law change, and we're going to talk about that more. But really what's kind of added some fuel to the fire around taxation was all of the stimulus that's happened over the last really now 14, 15 months. We've seen an incredible amount there, which has further added, I know Johnny will love this tool here, to the national debt. And once your nation has so much debt, there's obviously some concerns there around how you're going to pay for that debt, which again is fueling that taxation question. And so, John, I'm going to put it to you. Where are we at right now, and how did we get here from your viewpoint?
Go back to that tax clock real fast, or that debt clock. This slide, if you guys have never seen this, it's a phenomenal slide, and it's online as usdebtclock.org. I'd encourage you to pull it up. Put it on if you want to get frustrated every now and then. Just pull it up and leave it on your phone. U.S. national debt was shown here at 27.8. Drew, what is that? Is that $1 trillion? Yeah, that's $1 trillion.
That's brilliant,
right? I mean, that's a humongous number. And the thing of it is, this snapshot was actually from a couple of months ago. We're sitting at $28.4 trillion now, 4 months later. And, it's a lot of things there, but this impacts us in a huge way. And you can flip it if you want. But, man, that usdebtclock.org, it shows where we're at. This national debt has been growing drastically over the last couple of decades and is growing at an accelerating pace. And it doesn't matter if we have a president that is a Republican or a Democrat, the national debt is growing. And some people say, well, sometime we got to pay that back. Well, there's certain economic theories that say that federal governments, whether it's U.S. or anywhere in the world, they should never pay back their debt, just continue to service the interest rates. Well, that works okay, I guess, if we are in a very low interest rate environment. But as interest rates rise, it's going to get a larger and larger portion of the federal tax receipts through taxes just to service the debt and to make the minimum payments of interest and a little bit of principal. And so debt is one of those big things. The other thing that we're seeing, and Drew, you had mentioned the Tax Reform Act back in 2017, that lowered tax rates and low rates of other adjustments as far as in the tax code, where corporate rates went down to 21%. We had individual rates also decreased down all the way down to the 10% bracket. And so everybody had some significant tax savings in that. And so we have that setting things up. We had the raising of the national debt. And then on top of it, we had this pandemic over the last year. And unemployment was high. It's still trying to stimulate the economy right now. trying to do things to get the growth in the economy to come back to where it was, and that's all being done with additional tax dollars. And so the U.S. government doesn't have a whole bunch of money sitting there on the sidelines to do something with, so they're going to have to actually get more revenue in order to be able to take care of paying for all those initiatives. So those three things together, on top of it, we can talk hours and hours about what else is down the pipeline. We could throw out Social Security and changes both in disability and in the retiree benefit of Social Security. Together, those are set. They updated the number again last week in 2034 to be out of money there. There needs to be a change there. And so that's going to be an increase in payroll tax coming on. And so where are we right now? We're in a bad spot right now, just to kind of put it bluntly. When we work with individual investors and they come in and they have a debt load, a personal debt load, and they just want to say, hey, we have some goals to accomplish. What do we need to do to put us in a better spot? It's like there's two things you can do. You can cut your spending down as far as on your annual expenditures, and then you can increase the amount of money you have coming in. And so you do a side hustle, you start driving for Uber, you deliver pizzas, whatever you can do. You set up a new business on Etsy, a new Etsy shop or whatever it is. You set up something to increase your revenue at the same time you're decreasing expenses. Well, then you can supercharge your debt payment. Well, we're not seeing that at the federal government level as far as decreasing expenditures. We change administration, all they're doing is at different priorities. They're still spending more money. And then on top of it, we see things that are happening in the system where tax rates are set to rise no matter what in 2025. So we're not in a good spot, Drew. We got here through not just one administration. Let's remember that. We got here from decades of politicians making poor financial decisions over 40, 50, 80, 100 years that got us into a bad spot right now.
Right. It's been a long-term track record of mismanagement to get us here. And then we add on some forward-looking things of saying, hey, where are we going from here? Both from a policy standpoint, economic standpoint, but also from a taxation standpoint. And, there's a number of things in the pipeline. You mentioned the changing administration. Obviously, we saw the original $1.9 trillion stimulus plan. There's been questions around, was this necessary? Was it all necessary? As there was some money that was maybe not spent from a previous stimulus package. This came out yesterday, actually, and these numbers are a little bit off, but President Biden did propose an increase on the top capital gains tax rate. And I know, John, you'll definitely want to talk about that in a second. And you also mentioned this. We're going to see an expansion in the payroll tax. We've seen that there's been some discussions around the reducing or removal of the pass-through tax option for real estate transactions. There's going to be a lot of windows closing, in theory, in the tax code, and tax rates are going to be going up. And I think the big piece here that's kind of the ticking time bomb, so to speak, on taxes is that the Tax Cuts and Jobs Act that we've talked about a little bit here from 2017, it's going to expire after the 2025 tax year, which means that we're going to revert back to higher tax rates and narrower tax brackets. And so, in theory, everyone is already scheduled to get a tax increase, right? Before we start factoring in some of those other initiatives from a government spending standpoint and from a tax increase standpoint. And so, John, where do you see us going from here, just with reading the tea leaves, so to speak, and how is that going to impact future taxation?
Really, the taxes are going to drive a couple of different things. It's not just the tax rates we pay, it's also the economy, and it's also the stock market. And it affects interest rates. And so it affects us all in big ways whenever there's tax policy change. And so what's been floated out there is that, and we're talking about coming from politicians' mouths, about just the top income earners are the ones that are going to see an increase in taxes on the personal side. We know corporate tax rates are going to go up, and they floated going from 21 to 29%. It may not go that high. It may settle somewhere at 25%. At the end of the day, though, are the corporations going to simply eat that cost, or are they going to pass it on to ultimate consumers? And so, there's some argument on that. I think that where we lay is that cost is going to be passed on to consumers in the form of rising prices to pay for increased taxes. And so we know that's going to happen. The next thing we also know is that individual income tax rates, the top three brackets, are going to be going up. So if you make above $180,000, I think you can pretty much plan on your income taxes going up. And so back to at least where they were in before 2017. And so 37 is the top bracket, up to 39.3, may go as high as 42%. If you're at that 39, that top bracket, you also have to throw in your Medicare tax on there, which is an extra 3%. That's going to get you up to over 42%. Well, now there's discussion about the capital gains tax being altered. And so let's say you paid, 50 bucks for some Caterpillar stock, it's now worth $200, and you sell it, you have $150 of gain on that stock, and you have to pay capital gains tax on that. Well, right now, the highest capital gains tax rate, it can be 0, or it could be 15, or it could be 20. And so if you're at the top tax bracket, it's a 20% capital gains tax. They're talking about doubling that to 40%, which was brought out yesterday. And so that's a huge impact from a tax standpoint. There's also some discussion that at death, currently, if someone passes away, there's a step up in cost basis. So back to our example, you bought CAT at 50 bucks, it goes to 200, and you love it, and you're so excited about hitting $200 a share, you have a heart attack and die. Well, then your heirs, their cost basis, they actually don't pay tax on that. They inherit that stock, and they don't pay tax on it. There's a talk about elimination of the stepped up cost basis. Well, what is that? Well, I'm not in that top tax bracket. That won't affect me. Well, when it was announced that they're going to double the capital gains tax rate, the Dow Jones Industrial Average was up about 350 points, ended up going down 450 points in a matter of an hour and a half. And so why did that happen? Well, it's because everyone recognizes that people are going to start resetting portfolios and selling and taking gains in a year in which taxes are lower. And so it does affect that. And so that will affect your 401k. That will affect more. It will introduce more volatility potentially into your portfolio. So, big picture, we see tax rates are going up. We still might see the 10%. I think the 12 is going to go to 15%. The 22 is going to pop to 24 or 25%. So those things will happen. Everyone will be paying higher taxes at the latest in 2025. We think it might be happening sooner than that.
Right. And there's going to be the direct impact of higher taxes that you're paying and seeing. And then you kind of alluded to this. If the capital or if the corporate tax rates go up, there's also going to be some indirect costs that maybe you're not necessarily seeing, but we're going to see some increase in price of goods and services as well to kind of offset that corporate income tax rate increase. So taxes, suffice it to say, are going up. And I think the natural question then is, hey, what can we do to help protect ourselves so that we're not paying more than our necessary tax rate? No one likes paying taxes, but they're a fact of life, right? We have to pay them. And so I want to talk for a second, John, about the micro view of taxation and the macro view of taxation and what that means for our clients. Can you kind of dive into what's micro versus macro?
Yeah. When people think about taxes, they think about when they go sit down with their tax preparer, or maybe you do your own taxes yourself, and you sit down and go through the act of doing the taxes, and they simply write down and says, hey, you get a refund of X number of dollars, and that's a happy day, or you have to pay X number of dollars, and then you're sad and you're mad at your tax preparer. And so that's the micro view. It's actually the preparation of taxes. Well, the reality is that's simply a recording of what has transpired or happened in the past. It's not has to do with planning. It's just a micro view. Here's my information, my W-2, my 1099. Here's how much I withheld, here's how much I owe, or how much I'm getting back. That's the micro view. The macro view is what we do. The macro view is the planning ahead. It's looking big picture. It's saying, hey, of everything that's happening in the world and of my goal objectives, what are the best decisions that we can make to help us realize our goal objectives, to maximize our rate of return after tax? And it's about keeping more of your money in your pocket. So in order to do that, you need to be making some conscious decisions that are logical that you can go through to decrease future and total taxation. And what you want to do is you want to have a tax diversification review where you can go through and say, hey, of the taxes of the money that I have and of the decisions that I can make, what can I do to decrease my overall level of taxation? So this is basically not tax avoidance. That's illegal. That will either put you in jail or that's going to have a tax law named after you. So we're not talking about that, right? We're talking about navigating through the Internal Revenue Code to make decisions to lower your overall taxes. And so one thing is you might say, hey, there's 3 different types of buckets of our money that can be taxed in different ways. One is taxable in the current year. And so then let's say you have a CD and you have interest that you earn on that. Well, you pay tax on that interest in the year in which you earn it. Or tax deferred, the middle bucket. Well, that tax deferred, that could be something like your 401k. You take some of your income, you put it into your 401k, your 403b, whatever your IRA, and you're simply saying, let's go ahead and defer paying of taxes until some point in time in the future, and then when you pull the money out, then you pay taxes on that. Or let's say you happen to have an annuity. An annuity is another great example. It's been around for hundreds of years. An annuity is simply a savings or investing tool in which the earnings that you earn every year, you do not pay taxes on those until you pull the money out and use it. Whenever you pull the money out, you pay taxes on the interest. So that's tax deferred. There's some type of real estate investments that fall in that category. And there's even some ways within your real estate investments to have your taxes become deferred or not having tax at all. The last bucket is the one I love. That's the income tax-free bucket. The income tax-free bucket simply is dollars you set aside for savings or investing, and you don't pay tax on your earnings at all. That's like a Roth IRA. And so you're not paying taxes on your Roth IRA on your earnings. Or that could be like a life insurance policy. And so you have earnings inside of there. If you structure it properly, you're not paying taxes on the money coming out of there. And so it's about shifting money from the taxable bucket to the tax deferred bucket to where you have some control on when you're paying taxes all the way over to the tax-free bucket. And it's about making those decisions at the right times and in the right ways. Drew, a lot of tools of doing that personally. I'm moving a lot of my money in different tools to the tax-free, income tax-free bucket. I'm utilizing cash value life insurance on my personal story. I'm utilizing different types of trading strategies. I'm utilizing Roth IRAs. And so we utilize different tools. What I do may not be appropriate for everyone else, but that's why we kind of walk through and say, how do we take advantage of those lower tax brackets? How do we go through and have an asset conversion review? We do that uniquely and individually for every person to say, what's the best way for you to lower your overall taxation?
Right. And I think that's, a huge thing we've seen over the years. A lot of people, if I just go back one, they get stuck with most of their assets in that middle bucket, right? And the tax deferred. And what we're seeing is we are knowing for a fact that we're going to have taxes going up within the next 5 years. And so if you're having the majority of your assets, especially your retirement assets, sitting in a tax deferred bucket where we know taxes are going up and they might be going up more than what we think, you are setting yourself up to pay taxes at a higher rate in the future than what you may be able to pay them at now. And so finding a way to take advantage of that conversion review that we do for our clients and incorporating that into your comprehensive financial plan, we've seen it add a ton of value for clients and think it'd be well worth the time and effort for each one of you to go through. Yeah. And so, John, from a tax overview, any last words or thoughts here as to what people need to keep in mind?
You guys, keep in mind, number one, taxes are going to go up. And I think it's not a surprise to any of us. It's going to impact how much you're paying in taxes. More of your dollars are taken away. If you have a 401k, you have a silent partner in your 401k. And if you're in the 25% tax bracket, that partner owns 25% of your 401k. That silent partner is the IRS. And so the reality is when you pull the money out, you're giving up 25%. If you have $1 million, you really don't. You only have $750K you're able to spend. What are the strategies that you can do to decrease that partnership ownership as far as of your investments? It's about making sure you go through a proper strategy to lowering overall taxes and not just making the best tax decision, but making the all-around best financial decision, which simply is saying, let's look at everything together. Let's figure out how we can logically structure things in order to lower overall taxes. It's something everyone should be doing every single year.
Yep, absolutely. Something everyone needs to do. A lot of people don't take advantage of it, and you're setting yourself up to really be in for a rough time by not preparing correctly. So definitely take advantage of it. We will gladly do that for each and every one of you. And if this brought up any questions for you or you want to take advantage of that conversion analysis, shoot us an email, schedule a call with one of our advisors, and we'd love to chat with you. So thanks for your time, guys. We appreciate you, and we'll talk to you soon. Have a good one.